Okay, so again, welcome. If you all have any questions about any of the, there's a few different concepts we're going to be covering today in terms of strategies that you can take for withdrawals. If you have any questions on those things, please reach out. As always, you've been a good job of sending out questions to me, and I'm getting to them the best I can within in the day and whatnot. So, this webinar, we're covering withdrawal strategies and really how you plan to withdraw your retirement savings, along with asset allocation. I would go into that, but it's really just as important in determining things versus how you saved it. And so we're going to cover a various different amounts of 4 or 5 different strategies that you can do, and maybe pick for you that are available. And you can find this information out there anywhere. But first, I want to take a minute to talk about something even more basic, and it's about a question that I get honestly quite often, and that's really even the basics of how do I access my money in retirement from, say, a 401k? How do what is the mechanism of me getting that? Like, do I have to call and ask for it every month? Can I set it up in an automatic deposit into my account each month? Do I do that on a quarterly basis, an annual basis? Can I withhold taxes? All of those kind of things. So I want to start with just the basics of accessing withdrawals. And so first, if your money is staying in your employer-sponsored qualified plan, then it's going to be important that you need to contact your custodian or record keeper for specific options available with you within your plan available to you. In my experience, typically custodians in 401ks or 403bs typically charge a withdrawal or a distribution fee to kind of access your money. And that can be, I've seen it all over the place. I've seen it as low as 15, and I've seen it as high as 99 per distribution. In addition, some custodians may limit the amount of distributions you're able to have in a year. But most of them, in one way or another, charge a fee for that distribution in order to kind of get that. So obviously, if you're taking it on a monthly basis, you might be paying more in distribution costs than not. So fees are a consideration. The specifics of how often they want you to, or allow you to be able to take the money out, whether it be monthly, quarterly, or yearly. I kind of prefer the monthly or quarterly if it's available, because you're dollar cost averaging the money out just as if you put it in versus, starting the year, taking a year's worth, and market might be down or whatever. Most of the withdrawals from a custodian or record keeper will also require, particularly in retirement, federal withholding. But not all of them are a little bit different on that, but it's typical. You can choose to withhold, or they'll withhold 20%. On the positive note, if you are still inside your record keepers or the custodian of your employer plan, once you turn 72 and required minimum distributions kick in, the custodians will help figure that for you of what your required minimum distribution each year that you would need to take. I would add to that you kind of do an estimate, but because it's based on what your December 31st balance was times a factor that's really the IRS puts out there that's associated with your age. And then that tells you how much you have to take out in that year. I would say that I would also look at that not only to start the year based on your December 31st balance, but I would also go back and make sure that it was correct and that you're on target, say about October. Occasionally people wait until the later months of figuring those kind of things out of the year. And then sometimes you have to take a bigger amount out than what you planned on. And so it's important, and that's a very big perk of helping you navigate the required minimum distributions. Let's talk about that versus, say, an IRA, an individual retirement account. This would be where if you did a rollover from your qualified plan or your employer plan into an individual retirement account. And this is just kind of a little bit of what I see between the two, because there are many people on this call that already have IRAs. And so, typically there's a bit more flexibility when taking withdrawals from an IRA. So it doesn't really matter if it's a Roth IRA, a traditional, a rollover IRA, or even a SEP IRA. IRAs often do not have fees associated with setting up like a regular or periodic withdrawal, say on a monthly basis direct to your checking account. Those are EFTs, electronic funds transfers, that are set up. So typically you don't see that in IRAs. And most of the people that I see in IRAs take it out, on a monthly basis, closer to what they're used to in terms of bills for how they, were when they got paid. Another advantage is that you can typically, once you have those electronic funds transfers or that periodic withdrawal set up, if you need more money, it's generally not a problem to call the custodian of the IRA and have them push a little bit more, even outside of what your regular was. Those things are very easy to do and take care of. And again, typically no distribution fees on the IRA. The other part of that is that for withholding taxes, that's really a total option up to you all. Some people do it and you get to choose how much you want for federal and or state if you choose to withhold it, or you can choose not to withhold it. And then when your tax bill is due, just take a withdrawal from your account or your savings to help manage the taxes that are due in that. Most people, what I see in retirement, will pay estimated taxes anyways. And so that's a little bit less applicable, but you kind of figured that into what your expense is. Most IRA custodians will not automatically help you with your RMDs or your required minimum distribution. Some will, so I can't say all of them don't. Some will. You call and they will help you figure that. Typically an IRA, if you have an advisor associated with that, then they will help you navigate those required minimum distribution years and make adjustments on those from year to year, because as you get older, those withdrawals go up as well. There's a lot of factors in terms of what you can't control that could impact your withdrawal strategy. So longevity, I always say there's 3 questions that have to be asked when retiring and determining your withdrawal strategy. And that's, you've heard me say it before, how much money do you need? When do you need that money? And the last one's for how long. Longevity is something we have to plan for, because that's the factor we really don't know. Investment returns, your strategy should be flexible enough to take into account for some market fluctuations. Some of these that I'm going to go over starting just a second do not. Inflation, rising costs can influence, how much income you're going to need in the future. And some of these are more static in nature, and you might be impacted by inflation over time and have to make some adjustments for that. And then future expenses, unknown expenses, for sure, can impact, not in any strategy, those can impact any situation. The future expenses can have some effect on it. But all of these factors are strong considerations that kind of need to be looked at whenever you're coming up with a withdrawal strategy. So let's start with ones that that are a little bit more basic in terms of nature, and ones that maybe you've heard of, and this the 4% withdrawal rule. And this is a rule that when you withdraw 4% of your retirement savings in your first year of retirement, and then subsequent years on that, you would do 4% plus a 2% adjustment for inflation. Now it's a 2% adjustment of the 4%, not 2%. So you don't go 4% the first year, 6% the second. You would just adjust your need up 2% from what that 4% rule was. And an example of this, if you have $1 million saved under this strategy, you would withdraw about $40,000 during your first year of retirement. If you add that 2% of inflation, the second year, it would be just shy of 40,800. And then the third year, that would increase to 41,616, and so on and so forth. Potential advantages of this is this has really been a long-standing retirement rule that advisors and individuals have recommended to other people. If you can do 4% of your total savings or less, then you generally don't run out of money. That has a lot to do with what fixed income instruments and the overall breadth of the market over time can provide you in return without taking too much risk. But a lot of retirees value this strategy because it's simple, it's easy, it's predictable. Disadvantages, it's easy to criticize this because of rising interest rates and market volatility can have an impact on this. And, if you retire on the onset of a deep stock market decline, you kind of risk depleting your strategy. I would pair the 4% rule with a more conservative asset allocation strategy in retirement. Whether it be something less than 50-50 or those kind of things, you don't want to have everything in growth in this one, in my opinion, because if you start taking withdrawals while the market and your portfolio is way down, it can have a pretty big impact on your future. The next one is a fixed dollar withdrawal. And I see quite a few retirees kind of do this. And a lot of this, if you see, it goes back to that your budgeting and what your need was, less Social Security and other things. But a lot of retirees that I've seen, take a fixed dollar amount over a specific period of time. And an example of this, you might withdraw, say, $30,000 annually, and then reassess that after a 5-year period and see if that's still meeting the needs of what you need with inflation over that time. It doesn't help much if you do this indefinitely against inflation. So you do need to kind of make adjustments. 4 or 5 years is probably the longest I would go without taking a look at it. And depending on the dollar amount you choose, you could erode your principal a little bit quicker. But if your investments are down due to in value due to the market volatility, you may need to sell some of your assets in order to create that cash flow for your withdrawal needs. This approach can, amplify your personal money management. So, this is, you heard the term living on a fixed income. This is one of those strategies in which, are the people that came before us really kind of deem that that phrase, if you will, and for this particular reason. And taxes become much more predictable on a fixed dollar approach as well. Disadvantage, again, this doesn't protect you against inflation. And additionally, like any of these things, a down market early on there can kind of erode your savings if you're taking too much risk along with that as well. You're going to see a theme with this if you haven't already. Next, we have our what's known as a fixed percentage withdrawal, and that's different than a fixed amount. Fixed dollar is an amount, fixed percentage is a percentage, and that's where you withdraw a set percentage from your portfolio annually. If you want that on a monthly basis, you take that annual and then kind of just divide it by 12 and take that a month. The dollar amount of this distribution will vary. I kind of think that's a disadvantage. Because it's a fixed percentage based on the value of your underlying portfolio. And we're going to have some fluctuations in that. We've seen that now. And while this method creates a certain amount of uncertainty, if you choose a percentage below your anticipated rate of return, your account actually can grow in a manner over time more than what you're taking out. But on the other hand, if your percentage is too high, you risk depleting those funds a little bit prematurely, let's say. An example of this on the screen, let's say you have a portfolio of $1 million and you decide to take it out, we're just going back to that 4% every year. You might choose to do 5. Let's just say it's 4%. Well, that gives you 40,000 for that year. In year 1, you had $1 million. In year 2, you take out 43. This is 4%. The market was up. Year 4, but you can see year 2 and 3 were up as the market was up with it. That percentage of your portfolio went up. But then you could see the market had a decline, and the amount that you have to live off of is less perhaps than what you're used to living to. Again, super simple formula. I think this one, along with every one of these, just depends on what your risk that you're looking to take in retirement as well. The real disadvantage of this is the pool of money you're drawing from can grow or shrink, and so from year to year, the amount that you would be taking out based on your fixed percentage would actually change. And it could change significantly in some cases. So you have to be prepared. If this is something that interests you, you have to be prepared maybe to take a surplus of the money that you've taken out and bank some of that money in the future for years when the market is down and your portfolio is down with it. Next up, we have a systematic withdrawal plan. In a systematic withdrawal plan, you only withdraw income that's created from your underlying investments in your portfolio. Because of this, and because the fact that your principal is going to remain intact because you're just using the earnings to live off of. This is really designed to be 100% sure that you're going to prevent you from running out of money. By the time you pass away, and it really can give you the ability for your principal to remain intact over a long period of time. However, because the earnings, the downside risk of this is that your earnings are going to change over time too, not just in terms of return, but in terms of dividends possibly as well. So because of that, the amount that you would withdraw in this case varies as well. But you also take that longevity risk out of play in most cases. The advantage of this is you're only touching the income and the returns from your portfolio, not your principal. So you can go longer before you start touching that principal. And still have that ability later in life if that longevity is going to be, something that happens. The disadvantage is that, it's a blaring, but, you don't withdraw the same amount of money each year. And you can definitely get outpaced by inflation with this. I would say, and the reason is, it's not a huge concern, comparatively speaking, to some of the others for me. Because you're living off the earnings and you still have that principal, and you can afford to make some adjustments from that principal in the future if inflation becomes an issue and your dollar purchasing power is eroded, which is happening now. The grocery store costs more now than it did a year and a half, 2 years ago. Obviously, gas is the one that's in the news. But those things are temporary and they fluctuate, don't necessarily increase permanently over the long run. In full disclosure, this is probably the strategy that I use the most in helping clients with money. And it is known as the bucket strategy. And you see the buckets on the screen that we have here. It's broken down into cash, equities, and fixed income. You might have more buckets than just those three. We generally run ours as a cash/fixed income bucket. And we also have a diversifying strategies bucket, which helps us hedge against inflation. is exposed to things like Treasury inflationary protection securities, or TIPS. Those are bonds, government bonds or Treasury bonds that have an inflationary factor tied to it. Or we might have some exposure to commodities or other things that don't have a direct correlation to the stock or the bond market. And then, of course, equities or stocks or your growth. So under this strategy, your first bucket and let's just simplify it for the point of this conversation, but your cash bucket often has a percentage of your savings. This is why we combine the fixed income and the cash bucket when we come up with withdrawal strategies. And often it's, for most people, you're going to have 5 to 7 years of your expenses kind of in that fixed income bucket. You want those income needs met. So you want them in safety. Typically, we start with about 7 years in the normal course of market activity and market cycles. We're longer in a cycle, so we're recommending to our clients that are retiring, like right now, or are retired, that they have more than 7 years of income needs met. An example of that would be, let's say you need, for the purposes of, let's say you need $30,000, and we want you to have 10 years, just using as an example, we want you to have 10 years of income needs met. That would mean $300,000 out of your portfolio, whatever percentage of your portfolio, we would want those income needs met, and in fixed income and cash derivatives as well. So the nice thing is you can use the cash from this, or the income from your fixed income bucket, and you can live off those, know your income needs are met. And by setting aside several years of those income and living expenses, it kind of gives you, no matter where we're at in the cycle, no matter if the market is down or the market is up, it gives your equity bucket time to recover if it's down and come back. It gives you the ability, if it's up, to refill that cash and income bucket, which has to be done from time to time. If I have 10 years of income saved for you in this cash or fixed income bucket, you're living out of that bucket. Year one, this is how much you're spending. If you're spending, $30,000 and we have 300,000, that's 10 years of spending needs in there. So you're living off that, and as you're living, you're spending down that bucket. And we have to have the other buckets, it gives them time to recover, but when they come above what their original limits were, we might refill that bucket and get it back to that 5 to 7 years of period. But a lot of that, in terms of how much you want as a cushion in there, it does change a little bit. I mean, like I said, most of the time it's 5 to 7 years. We're over 7 years on most of ours right now. Potential advantage of this approach: it allows your savings and equities to continue to grow. And to me, the most powerful thing is it keeps you from pulling from that bucket when the markets are very volatile or maybe in a down cycle. It gives you cushion to spend over here, and it gives you that fluctuation. And the reason we kind of choose that, the market tends to run in 7-year cycles, 7 on, from peak to peak, the top to the top, and closer to 5 on the down cycles. So from trough to trough. But the reality of that is that sometimes there are things that extend that market cycle, and that's kind of where we're at today. So this is a common one, a theme. I've heard a lot of participants and clients kind of explain this, because you have these separate buckets, that it kind of gives you your own insurance policy, if that helps you think about that. I don't look at it that way, but I do think I can understand why people understand that. But this is the one that I probably use in most cases. If people call me, this is the one that they recommend, and this helps determine a little closer of what the asset allocation shouldn't be, more importantly, or possibly what should be. The percentages of the buckets that you have based on your income needs drive really that post-retirement. Should I be 50-50? Should I be 60% in safety, 40% in equities or growth? This kind of helps drive that a little bit, and is very efficient in terms of clarity for that. This is probably the one I prefer the most, but I've got clients on the 4%. I mean, so it's there is no right or wrong. It's whatever's easiest for you to manage and deal with. And the disadvantage of the bucket strategy, it is definitely more time consuming. It takes a little bit more engagement in terms of managing your buckets as you spend down your safety bucket, your cash bucket. You've got to pick when to refill those, and so that has to be done. And you don't shift money all the time, but you definitely shift it occasionally. And sometimes you want to be longer in your savings in terms of what those spending needs are. And sometimes it's okay to be back in that 5 to 7 year window. That minimum is usually that kind of 5 year, 7 year window for us. And then, of course, I told you there is no right or wrong when you choose this. I think any one of these strategies is good and it will work fine. It also depends on how you arrive in your asset allocation of taking risk. And you can always mix them. You can mix and match. And this approach really kind of helps you develop an optimal income plan for your circumstances that are there. As you think your way through major expenses that might be on the horizon, you can combine all of these withdrawal strategies or any investment strategy to kind of fund your various needs that might be variable on that. Or you can choose to go that fixed number route and make adjustments annually on that, and just make adjustments in terms of what you need as they come, and go from there. There is absolutely no right or wrong answer with those. There are a couple other strategies that you can look to do. They're even more complex and more labor intensive, but these are by far the most popular in terms of ease for you guys to figure out and do on your own. And a lot of it really will come down to all of those sources that you have available to you. And what I mean by that is, if you get a good portion of your replacement income, or a nice portion of your replacement income from Social Security because you delayed taking that, remember inflation, there are inflation adjustments for Social Security. So that part of it might be taken care from you from an inflationary standpoint, and your fixed dollar stuff, you might be able to go a few years without making those adjustments. So don't feel like you have to make these adjustments every year. I know it might seem like you do because inflation's on our minds right now. And oftentimes it's the most recent thing in our head that we're worried about or we're conscious of that we do that. Inflation is something that's happened over time, but it's not always a problem. And in fact, there are plenty of times in history when deflationary, and we're just, now because we have so much in the system, we're inflationary. Several years prior to this, we weren't. Our inflation was very low, very controlled. And the Fed is going to use its tools and its bag to kind of slow things down and get it under control. I don't have any doubt about that. But again, avoid common mistakes. Don't go and just spend frivolously. If you learned anything, the budget's important, and then that brings you to this withdrawal strategy of terms of whether it's a fixed dollar amount or a fixed percentage, or you have a bucket strategy, which still you need to know what your spending needs from these accounts are. So there's a reason this is where it's at and not up front, because it always goes back to spending and what our spending needs are. I'm going to stop the share and take questions. Let's see if we have any in the Q&As. There's one in here I see right now. There seems to be many fees associated with working with financial advisors, including mutual fund fees. Is there a difference between an advisor and a money manager? Should we work with an advisor or a money manager in retirement? Good question, by the way, Michael. That's a really good question. Let's break it down first. There are a lot of different types of advisors in this business. I would say most of them now do operate or have the ability anyways to operate in terms of managing money for you. Maybe it's financial planning that's included with that. That includes helping you with withdrawal strategies, telling you how much risk you can't take or shouldn't take. I'm biased because I feel the plan is as or more of importance than what the management is. I think almost every advisor now, Michael, can operate under a fee for service, meaning no commissions. There are still brokers and people that operate on a commission basis. Now, to me, a financial advisor or a broker, let's call it, would be different than a money manager. A money manager to me is an institutional term, meaning that they manage large groups of money. Now, you might find an advisor that manages everybody's, money in a specific way, and he just groups all the dollars together and manages it that way. But to me, when you're talking about a money manager, I'm talking about someone that runs a mutual fund. I do think it's important to understand whichever advisor, broker, whoever, what their plan for you is. And I think it's also important to understand if they are a fiduciary advisor or if they're not. If they're not a fiduciary advisor, that means they're only bound by suitability. And they can, there's any number of investments that can be deemed suitable. But a fiduciary has to take into account cost, what the purpose of the investment is, and if it's in the best interest of the client from all of those things, not only cost, return, possible returns, but suitability for that specific investment for that person and the costs associated with it. Suitability only binds you for the investment itself. Cost becomes less of an issue. So, and this is a long answer, so just bear with me. To me, it doesn't make sense to hire a financial advisor to manage your money and for that person to go pick predominant investments that are managed in a mutual fund. A mutual fund has a manager that runs the day-to-day and is actively managing that fund. It doesn't make sense for me, for Michael, for you to hire Hunter Nighbert and Hunter Nighbert go buy, I'm just going to name one, there's a million mutual funds, so I'm not picking on this fund company, but for me to go buy American funds and for you to pay me a fee and the mutual fund a larger fee because they have a money manager associated with it. To me, if you're going to pay a financial advisor, then they should be the ones that are advising that, and they should do it in the most inexpensive way possible. So when you hire, and I can only tell you how we do business, and there's a lot of different ways that people do it. So when you hire us, we might use a managed fund, but it might be for a very specific space. An example of that might be diversifying strategies. Majority of the investments that we pick are passive or indexed based, meaning that we build the allocations from of each one of those investments from each index, because it's the most inexpensive way for us to get broad-based instruments, and by inexpensive, I mean less than 0.05%, so 5 basis points in those cases. So from that standpoint, I think how the setup of what you're working with, and then what else they offer. I think a financial plan is tremendously important. I think it can be just as important as how they manage your money, quite frankly. If you're going to hire an advisor that goes and hires mutual funds, then I would say, Michael, you're a smart guy. Just go buy some mutual funds. Just buy adequate ones to where you're not taking too much risk, and then you're not paying someone else to do that. Obviously we work for a fee from our clients. There's no compensation, but we also provide more than just that money management for them. And I think that you should look for that. There's another option, Michael, that's out there that you're probably unaware of, that some financial advisors are going to. It's becoming more prevalent, and that's a subscription model in which you pay them a monthly fee in order for them to give you the advice, and then you go and make the trades if you want to. Some of that is an ongoing financial planning, and some of that is not. It's a little bit newer. It's only really kind of starting to emerge in the last few years. It's becoming more popular with younger people, not a bad way to go about it, quite honestly. I find value in working with an advisor, but that's an extremely personal question. To me, this is not know what you don't know. We can learn it. It's know what you won't do. And if you have more comfortability in letting a professional manage that, then look for a certified financial planner. I am partial to a fee-based advisor. What that simply means is they charge a fee per year. It might come out proportionally each quarter, but they charge a fee for the assets under management. So in other words, let's say you have $500,000 with me, and we charge 1%, just using an example. Then it's $5,000 a year, or or $5,000 a year to manage it. But the way most people do that is they take the balance at the end of each quarter and then charge you proportionally for that. I think fee-based is important. I'm very biased with that, not because I work for a fee-based, but it is really the only way to align an advisor's interest in your interest. And what I mean by that is, if you make more money, or you do well, or replace your money, then if you make more money, the advisor's fee goes up proportionally. If your account value is down, which it will be, so is the fee of the advisor proportionally. So I'm definitely against the old model of commissions. Doesn't make sense in there. Eric had, Hunter, another model appears to be a fee from a manager that's based on the percentage of your whole portfolio. Yeah, that's what I'm talking about. And almost brokers or anybody will go for that. And that's where you're right, Eric. It aligns your deal. And the fees are, it's mostly a 1% world. There are some that where you're above a certain amount in terms of savings or money invested, it goes down. That's different for every advisor out there. I would say this, that fee compression has been hitting the workplace environment, meaning 401ks, and it's continuing. I kind of see that trend going over into wealth management space as well. At my old firm, our fees were between 1% and 2% at my old firm, based on how much money you had invested. I don't think they were unfair by any means, but I do think it's mostly a 1% world, almost no matter how much you have. There are some that are higher than that if it's lower balances, and it's taken a while for me to understand that. I understand why that is. It's not just to simply grab more money. As an advisor, I'm a salaried person, and then they have goals in which I can make bonuses and some stuff over top of that. But it's not just me on my team on the wealth management side. I have a client service associate. We run investment managers. We have an investment management department with 3 full-time analysts and portfolio administrators. So it's not just me that 1% covers. It's spread out amongst, and having a minimum on the small amounts, you know, it makes sense. I know it probably doesn't peak for you guys for various reasons. So what other questions that we have? That was a good question, Mike, and I'm really sorry that was a long-winded answer, but that's not a simple answer, quite honestly. I think whether you should or shouldn't is totally the value that you feel. I've had clients that I got later in retirement because they were worried about their life expectancy and didn't want their spouse or whoever that was going to get the money to have to worry about that. And so they hired them. I've had people manage it on their own and then just up and decide, I don't want to do it. And I've had people say, no, I want you to help me with it. Help me with a plan. Help me with the spending plan. Let me know what I can and can't spend. Account for inflation, account for those things like big drops in the market. I want you to stress test this and tell me what I can and can't do. And I think that's where a good relationship with a value, that value is made, both from an advisor standpoint, and that's where the rubber meets the road for me. What are the questions that we have? Type anything in the chat or anything else. I like it, Eric. Eric and I have had a lot of one-on-ones over the years. I've gotten to know him, and he knows a little bit about my family, and I've known a little bit about him. And we live in completely different states. We're both Midwesterners, I guess, if you consider Kentucky the Midwest. But Eric says this: here's another approach: become a financial advisor with possibly one customer. If you go that route, then the MCF courses to learn for, you can do what you do, or just recommend training from other source. Yeah, I mean, I tell people all the time, this is not rocket science. It's not know what you don't know, because we can learn it. We can be engaged ourselves. This is know what you won't do. And if you're more comfortable with having an advisor, I think it's, I mean, I'm biased. I think it's worth it. I've made a living. It's a relationship business for me. Most of the clients that I've gotten, if not all of them, do business with me because they like me and I tell the truth. I mean, you've got to like who you work with, and that's the genesis for almost any sales or any relationship business in this world. And the financial advisor, if you find value in that, it's no different than having a CPA. We've got them. Some people need them and some people don't. It just depends on how complicated your situation is. Sarah says, you give me a lot to think about. I know, and I apologize for that, Sarah. This isn't meant for you to know the answer of this on the first go. This is just to kind of throw a bunch of stuff at the wall and make you aware of some of the things that you need to consider. And as you approach that retirement, you can do that. And here's the secret. The nice thing about having to think about it and stimulate this talk is when you call me for a one-on-one, and of course you all know you're available to do that. We're going to have some of these after we get through some of this, and you'll know more than you did before, and you'll understand a little bit when we get under the hood of looking at some of these things. I will help you develop your own plan, but remember, I've always said this: a plan is not a one-time thing. I can help you get started, but if you're going to do it on your own, a plan is a malleable tool that has to have adjustments within it from time to time. If you do it right up front, you can kind of, you can go by rules of thumb, and you can address pitfalls that could happen. That's what good plans will do. But in all, planning is what it's all about, and this is just another step of that. So I don't want to overwhelm you. I just want to do just what you said. I've given you something to think about, and it's okay not to know yet. I want you to know that. Another question just came in. I plan to retire in 4 to 5 years. So should I come into the office? I had seen another advisor in your office several years ago. Don't remember his name, and I'm assuming I need to come in this year to meet with you guys. Yeah, so Joanna, you probably have seen a couple other people in our retirement planning specialist position. And that was, hopefully you won't see as many. I think we're going to add to this. There are going to be people that work with me specifically. We had a change in philosophy in our office from that standpoint, and it came from the top. We had a lot of people in this position that honestly that we were having some turnover. I came as just an advisor and a wealth management person. I was in the institutional space. I had some experience in that, a lot of it teaching myself, and a lot of it, the whole reason I came to MCF was to help shore up my shortcomings with their level of expertise. And so we did have some turnover. It was the genesis, just happened to be through dumb luck, if you want to know the truth, of me helping out in this position. We had a couple of different of our big leaders in here were females, and they were both happened to be pregnant at the same time. Our basically CFO and chief planner, and then our director of institutional services were both pregnant at the same time. And and we lost a person in this position. And so I was asked to come on and help fill in on this position because we had a younger person. We had a lot of turnover because they were using this more as stepping stones to try to get, they felt like they should get advisor position. But what I came into is that there was a tremendous opportunity, not only for me, but people need help. And it was another, honestly, good opportunity for me to develop relationships with participants. Eric gives me a hard time. I give him a hard time. We have one-on-ones, but I thoroughly enjoyed the relationships that I've developed with people over the last 3 years, and really going into 4 of sitting in this position. And it's been mutually beneficial. It's been beneficial for the information that I've met with and helped people one-on-one. Number one, that's the right thing to do, but I've also gotten clients from it. And so, the answer to your question, Joanna, is yes, you can come in. I'm guessing you're nearby. If you want to start out with a Zoom meeting, happy to help and set that up. And absolutely, I think that if you're planning to retire, I think there's no better time to and I think I remember your name. I think I know who you work for, and we actually did retirement planning sessions with your company when we first got that plan. I remember that. And I didn't have you, I don't think, but we can help with that for sure. And I think this is as good a time as ever. And the reason 4 or 5 years out is good. The whole reason we do this now is so, if you're not exactly where you want to be, it gives you a few years to make some adjustments and help close that gap if there is one. All right, what other questions we have? Emily just threw my Calendly out there. Feel free to sign up for a complimentary one-on-one. Of course, you guys are always available to do that. I would say we're going to have that even more offered toward the end of this. It might get a little bit busy, but as we get farther through there and you all have absorbed a little bit more content, then we can kind of get into more specifics when we have those one-on-one calls. In terms of information that we're looking for and the information that you're going to need. So, but of course, absolutely, if you're having an issue now, please go on and get that one-on-one or call. Okay, let's see. Yeah, Eric wanted a couple certification. Our staff is colored up and down. CFPs, Certified Financial Planner. We have CFAs, which are Chartered Financial Analysts, various levels of those. We have CPAs. We have an attorney on staff. CRPCs, which is it's actually not certified. The Certified Financial Planner is a CFP. A CRPC is a chartered retirement planning consultant or certified. It's kind of the same thing. The definition, they all come from the same place almost anymore, and that's the College of Financial Planning for that as well. Any recommendation for you MBAs? I mean, generally you guys understand the accounting of that. I would say the biggest thing is to figure out what your approach is. The bucket strategy makes the most sense. It's the most nimble, but you all have the capacity to kind of do that. And there's a lot of MBAs in our business that just use their MBA in place of the College for Financial Planning designations that we have. But yeah, 2 CPAs on staff. I think it's always good from a tax standing standpoint. I know, Eric, that's always at the top of your list. So I think necessarily looking at some of those options in the future are big on that. But you know, Eric's a smart guy. He knows exactly how to do this, but he might not want to do it forever. You know, it gives someone else another look. The subscription model is really good too. Eric, so you're asking about the certifications? No, I mean, if you want to, unless you're going to really serve other people, there's really no, honestly, there's really, it's not necessary for you to get it. If you are going to look at one, I would say the CRPC is probably the quicker, easy one to do. I don't want to say it's easier because it's actually just a little bit more intense. The CFP is a longer get. And in fact, I've started portions of that, but in fairness, I'm not a CFP, but I have plenty that I lean on. But I do have 25 years of experience, and I should have gotten it by now. I've waited a long time. There's a lot more modules that you have to cover. The CRPC will get you out of a couple of them. That's where I come in. But yeah, I would start with that one, and it covers. I mean, it's like a more intense version of this. There's a little bit more calculations in terms that you're going to have to make. And they still do it the old-fashioned way. Instead of using tools, they still use the calculators, the TI 80s and TI 85s and those kind of things that do amortizing functions and time value money functions and those kind of things. Kaplan offers several. They have the CRPC review course that's really good. You still have to sign up through and they also, the College for Financial Planning has plenty, and they offer a lot of online courses now. So the College for Financial Planning, which that's what hosts and gives the designations of CFP, CRPC, CFAs. They're the most popular in our industry by far, but Kaplan does have some. I did Kaplan course for my Series 7 before I passed that. Any other questions? Well, that's about 1 hour with questions. That's not too bad. So I'm going to leave you all with that. Thank you all for tuning in. You all have a wonderful day. We'll see you sooner than we did in the last time. Look for those emails. Got another one coming Thursday with some content, a recording next Tuesday that I think you're going to be interested in. And then, of course, the estate planning one, it will be a good one. That one could be longer than an hour in my experience. There's a lot to cover, and while we have the expert that's going to be with us, who is an attorney, that will be great. You're very welcome for the information. Really appreciate you guys attending. If you have any questions in a long time, no problem at all. So have a great day, everybody.